Many years ago, I had a job for life. I was a civil engineer. I was working with gravity, with planet Earth, and with the British standards. Nothing changed. Maybe the Earth shifted a bit. It was incredibly stressful. I then joined Salomon Brothers, the investment bank, to build proprietary systematic trading systems. It was exhilarating, but there was a problem. Everything changed fast, and you had to adapt fast and constantly reinvent yourself to remain relevant. One of the biggest changes that took place in the following 35 years was the shift of trillions of dollars from active to passive investing. It was actually a paradigm shift affecting thousands of careers in the financial markets. The two pillars of investing, active and passive, have their strengths, but they also have their weaknesses. Today, with the advancement of technology, there is a third way of creating and consuming investments. This is a story about my endeavor to remain relevant through the fast changing world of systematic investing and how that led me to a new way of investing, which I think is going to dominate this decade. Active investing enables the fund manager to encapsulate their investment edge within a fund. This is then sold to investors by revealing enough so that the investor is able to evaluate the fund, but not so much that the investment edge is lost. I launched my first active fund in year 2000. It was a European market neutral systematic hedge fund investing in single stocks. 3 years previously, I had developed and helped trade a similar strategy on the proprietary trading desk at Salomon Brothers. It was based on my research into style investing, which is today's factor investing. Unlike in the US, in Europe, it was only now that we had sufficient historical data to make a case for these strategies. I had an investment edge to protect. Active investing enables the fund manager to protect their investment edge and prolong the outperformance. But the lack of transparency meant that investors were not able to distinguish between the authentic funds and those funds that were not living up to their impressive labels. For example, many were seen to be no more than the market index, but yet charging the higher active management fees. Discontent amongst investors was growing. Over time, some systematic strategies and methodologies became increasingly widespread. And then around 2011, there was a significant development. A new and powerful idea was taking hold, driven by leading index companies and investment banks. And the thesis went like this: that there are some systematic strategies that are established both academically and in practice, and that the returns they generate is a matter of general mechanics of transparent systematic investing rules. And the return should be seen as an alternative beta rather than born through manager skill. And as they are transparent and mechanical, you don't need fiduciary responsibility to promote these strategies. Index companies define these long-only smart beta indices, and asset managers launched ETFs based on these indices. Investment banks offered investment solutions based on total return risk premia indices. Transparency was the hallmark of these passive investment products. Let me demonstrate the power of this idea with one of many sets of indices that we offer. This is strictly not investment advice. Here are 5 of the most established strategies which are represented within a long-short beta-neutral framework. The tradable composite index is built as the strategies are incrementally added. This is the power of diversification of lowly and negatively correlated strategies. And then, of course, there is the geographic diversification as we add Asia Pacific, Europe, and Japan. You could do the same thing with long-only construction, which would then be smart beta. The red line is the combined market. I've sped through this example, so if you are interested to see more detailed version of this, just leave a note below. In 2013, after having traded a couple of allocations with Brevan Howard, I wanted to build something new. Part of my alpha was now risk premia. I was entering a world where smart beta and risk premia was a buzz. Surely this could be my new purpose. After all, I've been doing factor investing since the mid-90s. As I researched into the potential for business here, it was becoming increasingly clear that the total transparency and the high capacity provided to passive systematic investment products would have a chilling effect on returns. Transparency to the investor was also transparency to everyone else, including the competition. Commoditization was inevitable. Commoditization is passive investing's greatest strength because it makes trading and owning investment products cheaper. But commoditization comes with crowding, and for passive systematic investment products, this would have a dampening effect on performance. Passive investing's greatest strength was proving to be the greatest weakness for passive systematic investment products. This was not for me. I needed to reinvent myself. The key lay in the productivity technology I had developed for myself over the years to instantaneously create and evaluate new strategies. Re-engineered, this technology today provides the degrees of freedom I have as a fund creator to investors so that they can create, evaluate, and trade strategies that suit them best. Investment grade customization ranging from the most mundane beta strategies to the most sophisticated hedge fund strategies. So how does this third way of investing compare with active and passive? Let's recap. Active fund managers are able to target a higher Sharpe ratio because they are able to access esoteric and conventional strategies. But the limited transparency they offer makes it hard to avoid poor funds. With only conventional strategies available to passive fund managers, they have to settle for a lower Sharpe ratio. But the total transparency they provide leads to commoditization and crowding, and in turn poorer performance. Imagine a world where an investor can create an investment grade portfolio targeting higher Sharpe ratio by accessing esoteric and conventional strategies for which only they have transparency. Imagine Smart Risk Alpha. This Smart Risk Alpha feature is a significant improvement on both active and passive offerings. Customization, as exemplified by Smart Risk Alpha, has many advantages over active and passive investing. This way of investing is likely to resonate most with nuanced and ambitious investors who seek greater precision and innovation. The new age of investing is here, and if you want a peek into the future, Smart Risk Alpha is here for you. If you want to learn more about this, just drop a note below.